Thank you, everybody, for being on for our 2026 halftime report. We have myself, Bob Gavlak, we got Sean Carney, and our Chief Investment Officer, Nick Gukin, with us here this afternoon. Ryan Mannon, our trusty COO, is here for the tech side of things. So just in case we have any difficulties, he'll be there. But the agenda for today, really just going to talk about year to date, what has happened in the market, a little bit about the drivers behind it, both from an equity perspective, but also diving into some of the bond stuff, the updated Fed chair, those sorts of things. One of my favorite pieces that Nick will go through is what's called our economic scorecard, just revisiting that and tying that to what we've already seen and what we see looking forward, not just for the rest of the year, but for the coming years as well. And one thing as we get this started again, one, please ask questions. And two, keep in mind, we're revisiting this and it's a short-term conversation. But as always, our investment philosophy is a long-term strategy, right? So let's continue to keep that in mind that we are looking at this on, kind of like a 6-month basis. But we always want to make our investment decisions with the proper timeline in mind. So let's not overreact or get too caught up in what the short-term movements are.
Yeah, that's a good one. Way to zoom out, Bob. I'm all about zooming in, so that's good.
There you go. That's right.
All right, cool. So I'll take it from here. So 2026 so far, well, it's been a roller coaster of a year already. And if just had a blindfold on and are just joining us in 2026, well, stock market's up 10%. So congratulations, we made it this far. But it was obviously not a straight line 10% return. So kind of a fun chart as a timeline through the year here, and this is just January, but the first 3 months of the year were pretty flat, except for in February. There was all these advancements with specifically Anthropic rolling out their AI agents, and it was spooking the market about, how much are we going to need software? Can we just use AI to replace my software? That was kind of the big conversation there. Not to be then overshadowed by US and Israel striking Iran there at the beginning of March, which then caused basically a 9% total drop from the highs. And then from there, we didn't hang down at the lows very long. It was basically a rip upward there through May. We had a new Fed chairman step in. We had the SpaceX IPO and then the first big Fed meeting. And here we are at plus 10% on the S&P. So good year so far. Yeah, go ahead, Sean.
Oh, go ahead, Sean.
Oh, go for it, Bob.
Well, I think this is interesting because a lot of what, just in conversations I've had with clients that maybe aren't tracking this on a daily basis, like we may be, is yeah, it's not a very good year in the stock market so far, right? And the reality is that it's actually been, a continuation of potentially double-digit return years, at least halfway through here. And so that's why it's important not to pay as much attention to the news necessarily and what you're reading in the headlines, and more what's actually happening in the market.
And I think that first part of the year up until March, we're going to talk about this a lot later today, but there was a lot of concern about companies over investing in infrastructure for artificial intelligence, for data centers. And so the market was pretty shaky there. We get the war in Iran, and then we start seeing company earnings, which is going to be something we talk about later. And that's really been a big driver in the market leading up to that point. And then the Fed holds rates steady. A lot of that due to the rise in oil prices, which we'll talk about as well, and kind of stagnation from our drop in inflation coming down.
Yep.
Yeah, absolutely. I was just talking to a client. They're like, market's pretty flat or down from the war with Iran, right? And I'm like, well, the headlines certainly make you think that, right? Where it's, you only see the negative press, the negative days. But yeah, we are healthily hovering around all-time highs as it
Yep.
sits. This is as of the end of June, but even same is true today, middle of July. So, all right. So this is also one of our favorite super busy bar charts. And the reason we love it is it shows the calendar year returns of the S&P 500, and then the red dots are the intra-year drawdowns. So you can see even though most of the bars end up positive and healthily positive, um, there's not a year where there's not a drawdown, right? Like 100% of the time we get some drawdown in the S&P. That is totally expected. And this year is shaping out to be, if nothing else changed at the end of the year, this would be the most average of all years, with roughly a 10% drawdown, 10% return. So not bad, not bad. Again, the volatility is the price for admission to these big gains, but we understand that in those moments when markets are down, like it is stressful, and we're here with you all through that. So, okay. All right. So we've been talking about the S&P 500, and we're going to keep talking about the S&P 500 for the most part, which is the index, which shows the 500 largest stocks in the United States and US stock market. So it's a pretty popular index, but there are other things to invest in and other things that we do invest in. And, one thing is bonds. So that's the green line here. Nice, flat, stable, boring return in fixed income, but that's why it's in the portfolio. So it's been stable even through the drawdown we saw in April. Bonds held up nicely, so that's always encouraging. The orange line is small cap stocks. So again, the blue is 500 biggest stocks. The orange is the 2,000 smallest stocks. And then the purple is any stock that's not listed in the United States. So it's all the international equities piled together. So overall, everything's looking, nice and chipper across the board, positive numbers. So we are happy to see that. And we'll kind of get into more of these in more detail here. But main focus of today will largely be on the S&P 500. So, okay. We haven't shown you enough dizzying charts or graphs yet, so this one should do the trick. So this is what we call a quilt chart or a carpet chart, and it shows just a more granular look at the different asset classes that we can invest in, or some of the asset classes that we can invest in. And showing the 2025 return is the column right here, second on the right, and then the year-to-date column is right there as well. So you see the international stocks up there, small cap stocks up there, US large cap, the S&P again up about 10%. And then diversified portfolio is the white or the asset allocations, just like a kind of generic 60/40 portfolio. So overall, just trying to give a sense of how different areas of the market have been performing, but also it shows why we don't put all our eggs in one basket, right? Because we never know which asset class is going to be the big winner or the big loser in any given year. And so that's why we are diversified.
And I like to point at like in some of these, like if we look back to 2011 through 2015, REITs were at the top. And then all of a sudden, those have been near the bottom for, another set of years and they're making a rebound. Like the idea here is that we maintain diversification, understanding that some things are going to outperform our standard model, but we want to take the baby roller coaster, right? Versus the big volatility up and down, just to help smooth things out and get those good long-term returns that hopefully everybody is looking for.
Yeah, absolutely. Like it. All right. So if we double click into stocks here and kind of peel back the onion a little bit and say what's going on, let's do a deep dive. Some of the main questions that we've been getting is the same questions we've been getting for the last year or so is the stock market too expensive? Is there still upside from here? What are the major drivers and risks we see in the markets today? Is AI a bubble? That's a big question that we keep getting, especially as AI is at the middle of everything. And then, kind of in tandem with that, are the mega IPOs bad for the market? And so, IPOs are initial public offerings or private companies making the step to become public companies. So, that's been a big thing in the headlines as well. So, we're gonna get into it here. And I have plenty of charts and graphs. In fact, I had to peel back. Sean made me peel back like half the charts and graphs so we can keep it at a reasonable time frame. But we have some good stuff to show you. The first one is a deep dive on what's called the PE ratio, the price to earnings. ratio, which is probably the most common metric to measure how expensive is a stock or how expensive is the stock market as a whole. And so you can see this is again a year-to-date chart that stocks definitely became cheaper in April with that drawdown. But even from where we're at 6 months ago, the stock market is up 10%, the S&P 500. But the PE ratio is down 3%. So stocks have gotten cheaper over that time. And the reason for that is due to earnings. So go ahead, Sean.
Yeah, I think it's key to point out that buying stocks based on price to earnings is not what we're trying to represent here. Not saying that that's a great way to do it, but overall, if you think the market's overpriced, this is a data point to kind of reflect that even though it's up 11% in the year and near a market high, that in general it's still pretty discounted. When you think about is it time to put money in the market, which is again the question that we're answering here is we get a lot of questions of like, well, it's high, should I put money in? And or should I dollar cost average if I have a big chunk of money? And the data supports it. It's not overly priced. It doesn't look like the price is well above what companies are earning, and there is a bubble to that effect.
Mhm.
And I think if we go back to the beginning of the year, there's a lot of scaredness about hey, companies are overinvesting in technology and the war in Iran. Maybe I don't want to put money in there. So now you got to get to this July time point. If you've been sitting on the sideline, you've missed out an 11% return. And you're going to hear it from us kind of continually when we have these conversations is we don't know what's going to happen in the future. So either dollar cost average, or if we're playing for the long game, let's put money in the market because long term we're going to have a positive return. And so just a
Mhm.
good data point to show that market is not overly priced, even though we're near market highs.
Yep.
Yeah, love it. All right. So, love this one. Had to include it. So I have a 4-year-old who is big into the Disney movies, and got to say the old school Disney movies like this one, Treasure Planet, is far superior than all the new new shows that are out. So anyway, in Treasure Planet, if you haven't seen it, there's a little robot character who keeps screaming about the centroid of the mechanism, and that kind of that line stuck with me because I mean, repeated it 100 times, but. And this year, I think the centroid of the mechanism or the biggest driver in the stock market has really been the rally in tech hardware specifically. So we'll get into that, show you exactly what we mean. But if we look at the S&P 500 index contribution, so of that 10% return, which companies were the ones that fueled that? And this year, it's been almost 80 to 90% fueled by tech. And specifically, almost 20% came from one stock, Micron alone, which is a semiconductor company. And so it's a really big move in the market. And, it certainly, I understand why it gives folks pause when they see something like this. We're like, man, tech just pushed the market higher. How is everything else doing? Right. And we are going to spend a lot of time talking about technology, but the reason for that is if you look at the S&P 500 as an index and the underlying sector weights, technology is by far the biggest weighting in the index. And so that's why we're talking about it the most, because it is the biggest driver this year. It is the biggest sector. But we don't like exclusively invest in technology. Don't worry. This has just been the big driver. And specifically, technology, you can kind of break it into like hardware stocks, which are making like the physical computer parts, and then software stocks. And so, um, anyway, the hardware sector has grown so much. It's now 28% of the S&P 500, which is crazy. It's now like the biggest sub industry in the market. So, again, centroid of the mechanism, that is tech hardware. So we're going to kind of focus on that a little bit more. But if we look at the S&P 500 sector by sector, the performance as a whole, again, technology was the biggest performer, which is great. But hey, other things are positive too. That's always good to see. And in fact, industrials are largely positive, again, due to that AI capex and the data center build out, the construction companies actually building the giant data centers. A lot of those fall in the industrials category. And then the energy sector, the big spike that we saw in energy oil prices this year has certainly helped line the profits of some of those oil and gas companies. So again, there are some other bright spots. Some less bright spots would be the financial services sector, as interest rates have not moved the way that everyone expected at the beginning of the year. And then
Mhm.
communication services is kind of like a largely software-based index as well. So kind of get into that. And then consumer discretionary, this kind of goes into like the consumer sentiment numbers, but it's when people have extra dollars in their pocket, where are they spending it? So kind of think of like luxury goods, or even like Amazon falls in that discretionary bucket. So anyway, just an interesting shakeout of the market so far. Keep going along here because we had some good
Mhm.
stuff. Um, but the move in Micron and uh, hardware stocks is so interesting because this chart shows all of the biggest stocks, the top 10 biggest stocks over the last 10 years, or 10-year increments, decades. And so normally this chart's updated every 10 years, but if we just updated it right now in the middle of July, you'd see that we have some new big dogs at the top. We got Micron is now a top 10 stock in the S&P, and Eli Lilly, thank you Ozempic for pushing healthcare back into the mix. And yeah, so like it has been a very big move, so big that it's even displaced some of the biggest companies in the S&P. So that's really
And I
cool.
think, kind of going back to the previous chart, a lot of it we get
Mhm.
into, hey, there's a conflict in Iran or there's a conflict around the world, the geopolitical tensions. How is that going to impact the portfolio? People tend to get scared, but you can see some of the industries that kind of benefit from war. Right? You see
Mhm.
industrials, you see technology, you see that hardware. This week, someone who still serves in the military, we launched our first unmanned boat to blow up a port in Iran. More and
Mhm.
more dollars being spent by some of those defense sector could end up being good for the overall economy. Debatable on whether or not it's good for the world, but ultimately you can kind of see some of those ties there. So when we do see conflict, a lot of times it causes some fear. But when we look out, the portfolio is built to withstand conflicts no matter where they're at because it's so diversified. We're going to have enough exposure to all the places that we could see some growth because of defense spending.
Yeah, absolutely. Yeah. So the aerospace and defense sub-industry falls in the industrials category too. So between data centers and that, certainly fueling the growth there. All right, keep it going. So this chart has been called the chart of the year by all the finance nerds, so naturally had to include it in our deck. Again, just looking at the tech sector and the difference between hardware stocks and software. So the light blue line is hyperscalers, and you can see the note there at the bottom. That's Amazon, Google, Meta, Microsoft, and Oracle. Historically, the last 20 years, they've been super flush with cash. They have great earnings, and if they go and get a new customer or they sell a new enterprise to bring in, they don't have to go build a new factory. They can just sell more licenses, and therefore they're a very asset light business historically. That it has changed this year has been we've seen this astronomical shift between the cash flow. This is free cash flow, so not stock prices or anything like that. This is like the cash that they have on hand. And the hyperscalers, instead of hoarding that cash or using that cash for things like dividends or share buybacks, now they're having to actually spend that cash on what we call CapEx, or capital expenditures. And so they are dumping that money into the data centers and hardware stocks. So this is a huge flip. It's all within the tech sector. So if you just look at tech as a whole, maybe not much has changed. But there's been a lot of divergence between these two. So big delta there.
Yep.
So worth noting. We'll get into this. All right. So
Mhm.
then the question is, how does the market feel about these stocks that are no longer having all this cash flow on hand? Well, the light blue line is the software index CTF, down about 14% year to date, was down about 30% there in April. And then the purple is semiconductors, think of it kind of like a hardware index, up 82% year to date. So just within tech, like that's a huge performance dispersion as far as like, not all tech is the same. Um, but also the Magnificent Seven, or the biggest seven stocks that have been kind of the darlings of the stock market the last few years. Instead of being called the Mag Seven, now they're being called the Lag Seven, as they are now down 2% year to date. So we'll see if that continues or not. But market's really just trying to digest, like, okay, this was an asset light company, and now they're having to do these massive investments. What does this mean for their future outlook? And so, go
And the
ahead, Bob.
one thing you said too, Nick, that is interesting just about the Mag 7 in general is a lot of their returns over the past year were due to like the share buybacks that they do with their free cash flow. And because now they're taking that and they're looking at it, and these are the best most well-run companies in the world, right, that are investing huge sums of money into data centers, semiconductors, whatever it is from a physical hardware perspective. And so, as while we've seen these run-ups, it still show like it goes back to, do we trust that these magnificent seven companies know what they're doing with their free cash flow? And I think that we should, right? Like they are kind of the leaders in tech and industry. So not to say like, hey, this is, the Mag 7 is going to bounce back or prediction of the future, but it's just like they've lagged because they've used their cash a little differently. And, because they see this coming through.
And I think when you go back to the last couple years of us doing this presentation, we were always talking about how the Mag Sevens carrying the S&P 500. You can see that's changed, right? No longer
Yep.
are those companies doing it. They're now investing in that hardware. Hardware is now becoming kind of the top of the line. So a big shift kind of in the overall market. And you can see this kind of empirically when you look at Microsoft. Microsoft's down this year. We'd call that more of a software company. And you see a company like Micron who's up 300% in the year, right? So
Mhm.
there's kind of some practical use cases of how we see these things playing out.
Yeah, I'd be careful which micron thing you invest in there. But yeah, and then just going back to the this chart real quick, like the most interesting note too is the light blue line actually flips negative below that line, and what that means is these hyperscalers have actually exhausted all of their free cash flow, and now they're doing things like taking on some debt to accomplish this build out for the first time. And even Google is doing, most recently did a share issuance. So they're issuing new stock to help pay for the build out. So they're, like Bob said, these are the most well-run companies. They have the most, I'd say probably some of the smartest people to financially engineer themselves into a good spot. But yeah, the question on the true ROI is going to be one that we won't know till all of this dust settles into the future.
Yep.
Okay. All right. So, is it a bubble? This chart I think was probably the single. If I could only show one chart, this one would probably be it for the that answer. So, on the left, we look at Cisco during the dot-com boom and bust, and you can see the red line was their earnings, nice steady earnings growth, but the market got a little excited and the share price started to disconnect from the earnings, pretty significantly. And that is very different from the biggest stock. So Cisco was the biggest stock in the 2000s. NVIDIA is the biggest stock today. And you can see that their earnings have actually far outpaced their share price even. And the reason for that is people are just so skeptical, right? Everyone is scared of this being a bubble. And so the share price has not even kept up with the earnings across the board. That's why the market has gotten cheaper as we kind of go back to that. It's people don't trust that these earnings are going to keep on continuing. So we'll see how it shakes out. But so far is a very different story than the dot-com bubble.
Yep, absolutely. And I think that because I love this chart, and I think it was even like Peter Lynch famously said, who was a famous mutual fund manager back with Fidelity years ago. It's like, your earnings and the price, they always find each other eventually, right? Like you can disperse from it, like what happened in the dot-com bubble, but it's going to come back together and they're going to match up. And, I think that we're seeing that again, we're letting the earnings go ahead of even the price coming up with it. So, we're less worried about this being a bubble just because it's driven by the earnings as opposed to being driven by just by hope and speculation.
Mhm. Yep, yep. All right. So, the next question we got was about, are the IPOs good for the stock market as a whole? And to answer that question, just do like one step back onto what's been going on with private companies. And so, as we look today, there's about half as many publicly traded companies as there were in 1996 or 30 years ago. And so, it seems kind of counterintuitive. It's like, well, the economy is so much bigger. Surely there's more publicly traded stocks, and it's half as many. And the reason for that has been this big rise of private equity firms where companies are willing and able to stay private for longer and not deal with the public reporting requirements, all that. So much so that of the US companies with 100 million in revenue, 87% of them are privately held and only 13% of them are public. So when I say private companies, it's not, the deli shop down the street. These are still massive organizations with real revenue and real profits. So say all that to say, what about the IPOs? Well, again, the IPO is when a company switches from being private to public. And the question is that good or bad or indifferent for the stock market? And my argument is that they are good for the market as a whole because it gives investors access to the firms that are leading this big wave of the AI revolution. And I think it's great that everyday investors can now participate in the success of these companies. And it's not just like a walled garden where only private equity or only the employees get to benefit. So, specifically, if we look at like Anthropic is kind of the easy one to point to. It's probably the leading firm today in this space. And the chart on the right shows two things. Number one is the valuation. 18 months ago, Anthropic was barely worth $1 billion, and today it's worth over $1 trillion. So in 18 months, there's been over $1 trillion of market cap created, and Anthropic is considered a software stock, is the other thing, right? They are AI, large language model. So I think, if we look back over the last 18 months, software stocks have gotten so beaten up because of the rise of Anthropic, but Anthropic was not included in this index because it's private, right? So I think if investors had the ability to be invested in some of these hyper successful, super fast growing stocks, like that'd be net good and kind of balance out the carnage that they're also creating. And so, but yeah, their valuation, that's one thing, but the other thing, theme of today has been the earnings, right? So their earnings have gone from basically zero 18 months ago to over 44 billion in annual recurring revenue today. So, and they're doing that at 70% gross profit margin. So this is a very real, very profitable, very successful company that is disrupting a lot of things right now. And they actually just filed the headline today that they're pushing forward with their IPO. So we'll see this one likely go public in the next 3 to 6 months. I'd predict by the end of the year. So,
And something we wanted to bring up because SpaceX is a question
mhm,
that we were asked, dozens of times throughout this year is like, how do I buy in? Can I buy in? And
mhm.
the key point that we want to
Should I
drive,
buy in? Right.
Yeah.
yeah, how much should I buy? And so what we're trying to say is that this was a newer thing in the market where a company goes public, all of a sudden it's in the Nasdaq index or it's in the S&P 500, and so it is represented in your portfolios, and you may have some future opportunities through Anthropic or OpenAI if those go public this year, but it's kind of the ball is rolling towards that. So how do you participate? We want you to know you are participating. Over investing in it, we'll kind of get into the risks associated with it, kind of moving forward. But one of the reasons we want to highlight, these companies in particular and how the game has changed a little bit in 2026 compared to the past.
Yeah, absolutely. It totally busting the trend of companies staying private, right? Like this is a big step in a different direction, which I think is good overall and healthy. But what's not healthy and also slightly terrifying is if we look at all of these different stocks that have IPO'd over the years, what have they endured in the following 12 months after they IPO'd. Everything from Facebook to Snapchat or Spotify or Lyft or Uber. It's like almost all of them had, actually, all of them did have a huge drawdown, on average, a 55% drawdown from the IPO price. So I would say volatility probably should be expected. Would It's a good base plan if you're thinking of making any allocations to any of these. But in general, one of the reasons for all this drawdown and volatility is, again, those private equity companies, they would use an IPO as a way to get exit liquidity. It's like they invested in the company while they were private. And then finally, like the ending chapter, ending stage of that is take it public and then try to get their payday cash out and move on to the next private thing. So that has been a big piece of it. I'd say private equity's much less involved with the big three IPOs that we mentioned already. Um, I'd say also just in general, I know we just did a webinar on private equity investing, but it's a whole different pricing model when you try to do price discovery or figure out how much is something worth in the private markets versus in the public markets when you have people actively
Mhm.
bidding for it. And so all this volatility is largely just the market digesting, going from one pricing model to another pricing model. And so that's a big thing. It's not like there's anything inherently wrong with any of these companies. It's just like a dynamic of the market while it digests the new information.
So if you're
Uh,
investing in these trying to get rich quick, or because you got fear of missing out or because your buddy's doing it, use that with caution, right? Again, if you want to over allocate to it and have some concentration risk, probably makes sense for this to be a long-term play. If you want to
yeah,
try and buy in and expect to make 200% in the first year, that's not the way it works. Maybe for those private equity companies or the billionaires that got in on it and sell as soon as it peaks. But for the general investor, probably not going to have that opportunity to get rich quick and get greedy.
yeah,
Yeah, and
absolutely.
I think that's a great point there, right? And what we always want to try to point out to folks is, even like looking at the one that's a top line there, Facebook, which is obviously now Meta. I remember when that IPO'd and it was at, $30 a share or something like that for its share price. And now, it's this massive top 10, one of the biggest companies in the world. And if you invested in it with the long-term view of like, I believe in the vision of this company and believe it'll do well over the next 5, 10, 15 plus years, great. Let's keep that in mind, but let's not try to do some short-term wins with this. So even for those of our clients who do have any SpaceX exposure, like it might be in there, but almost don't even pay attention to the price for 5 to 10 years, right? Like these are long-term plays.
Yeah, absolutely. Absolutely. So on that note, Sean mentioned like, a lot of folks already have some exposure to this. And the reason for that is the indexes or the ETFs that we use, there's been some changes, not all funds have changed the same, but for example, the NASDAQ amended their rules. So now when there's a super giant company, specifically like SpaceX, Anthropic, or OpenAI, when they go public, they can now be added to the index within 15 trading days instead of 4 to 12 months. So that's a big difference in the structure, the mechanics of that fund. But the thing that nobody talks about is that the float still matters, or the number of shares outstanding. So SpaceX in particular had like 4 or 5% of the total shares that were available for the public to trade. That's still true today. And so the NASDAQ takes that, what they call the float or the public shares outstanding, into account when they give it a weighting in their index. And so, for example, even though SpaceX would be a top 10 stock in the NASDAQ um, because of the $2 trillion market cap, it's actually priced below, has a smaller weighting than Texas Instruments, which is a $280 billion company. So, the weighting will get bigger over time as more and more shares are allowed to be traded. But initially, it's a very small slice of the pie, not causing any like giant risk to the fund or to the index as a whole by design. So I think this is a good thing to baby step in, not rocking the boat a whole bunch one way or another.
Yeah, and I
Yeah.
think that's a really good way to kind of explain that, just because it got there, it doesn't become overweight in your portfolio. You didn't just buy all the volatility that's coming. right? The
Mhm.
NASDAQ is tempering that volatility for you to make sure that it is legit before they go ahead and give it its true weighting over time.
Yep.
Yep. And the S&P 500 was going to make a similar change, but then they voted not to at the last minute. So the earliest SpaceX could be included in the S&P is basically a year from now if they hit all their earnings targets and whatnot. So to be determined on that one, but it is worth noting because it's not only SpaceX, it's the other IPOs that are going to fall in the same boat. So, okay. All right. So enough of the stock market. Let's talk about bonds. Fun stuff
The
here.
fun stuff, right?
Yeah. Yeah. So, it actually has been a pretty fun year in bonds. So, a new era at the Fed. We have a new Fed chairman, Kevin Warsh. I'm gonna have fun saying that name for the next 10 years. I promise you that. And importantly, in his first meeting, he held rates steady at the 3.5 to 3.75 range on a unanimous 12-0 vote. When's the last time we had a unanimous vote in the government? That's amazing. So, give it to Kevin on his first meeting there. But his main things that he wanted to talk about, which are different and do matter, is he wants to modernize the Fed. So the Federal Reserve is the government agency that controls our money supply, controls the short-term interest rate. And they do that by relying on economic data. And unfortunately, they still use the same mechanisms to track data as they did when the Fed was created in the 80s and 70s. So, modernizing the Fed, switching to real-time data is one of his first priorities. I think that's a good thing. You've heard me complain about the lagging data. It's like a dog chasing his tail when the data is so stale and then they're making decisions. Kevin is also the youngest Fed chairman ever, and he seems to have a very good understanding of AI and its long-term deflationary impacts. So he's taking that all into account, seems to have a pretty good pulse on the economy and the market. And the other thing he wants to do is rebuild the credibility of the Fed because they've been so terrible at predicting interest rate movements into the future. And so he basically said, we're just going to not do those big predictions and y'all shouldn't put so much weight on the predictions anyway. So that's a big difference. What does that mean in the short term? They might get choppier without the usual Fed guidance. Like Warsh did not even submit his own dot for their dot plot projections in his first meeting to prove a point. But then also just again his focus on letting the economy be productive and not hamstring it with interest rate movements one way or another. So that's also yeah.
And this kind of conversation came up with clients throughout the year of like, all right, there's going to be a new Fed chairman. This is pretty scary. Uh, Maybe he's just going to go along with Trump and do whatever Trump wants. And for him to, again, hold rates steady when we know Trump wants him down, kind of gave him the
Mhm.
middle finger a little bit to say, like, and maybe just tell the world, like, hey, I'm not his puppet. I'm going to be independent. And we're going to do things differently in the sense that we're looking for new data but ultimately making the right choices so far given the rise in oil prices. And we'll see how that plays out, right? Don't know that that's not true, but we'll kind of see how that Fed chairman role changes throughout the year.
Yeah, absolutely. So this chart is the short-term rate, which is the rate that the Fed actually controls. And then the gray area and all the dots are everybody's projections on where they think interest rates are going in the market as a whole. Trump's target is 1%. He's been pretty vocal about that. That's very like disconnected from the rest of the market. And yeah, to Sean's point, the fact that Warsh did not just immediately slash rates in his first meeting, I think was a good move and him trying to build his own credibility, saying, exactly that. Like he is independent. He's looking at real data and not just taking orders. I think that's a good thing. So
Mhm.
we'll see how that
And
shakes out.
And the
Go
other
ahead.
thing that I like about him not cutting rates, right? And this is just from a, economics perspective, which we'll get to the economic scorecard later, Nick, which I love. But it leaves, if we go to 1% or just go lower too quick, right? It pulls an arrow out of the quiver if and when things do change from an economics perspective, right? Like if there is some, black swan event that we don't see coming and we need to lower rates to help stimulate the economy, leaving it up where it is actually a good thing to give us some flexibility to navigate those situations, right? So we don't want to just rush because, Everybody wants to be able to refinance their mortgage because we got used to 3, 4, 5% mortgages and now it's 6, right? Like we want to make sure that we have a good, healthy economy and that we have the flexibility to navigate what can be changing economic circumstances.
Yeah, absolutely. Love that point. So, all right. So then this is a snapshot of the yield curve. The dark blue line is where we are today, and then the light blue line is where we were 6 months ago. So, not a whole lot has changed. Everything has slightly drifted higher, and that's largely due to war with Iran and oil prices pushing higher, which then makes inflation fears go up, which then means rates have to go up in response. So, slightly higher than where we were at the beginning of the year, but not like a giant move one way or another. The biggest delta, I think, is at the beginning of the year, everyone was hoping and thinking that we'd have maybe some cuts sooner. Those kind of went out the window with the war with Iran. And outside of that, everything is in the, basically 4% range is when we
Mhm.
talk about fixed income, that's where we're looking right now. So.
Yep.
And this was a big talking point, with clients in the beginning of the year. It was like, hey, the market thinks 3 to 4 rate cuts are coming this year. And again, it's great. And I think this is Kevin Warsh's point is like, you guys are always looking for our guidance, but I have no idea when the next global conflict's going to kick off and the price of oil is going to go from $60 a barrel to $120 a barrel. So you guys keep putting all this pressure on us and all this forward-looking guidance, but we don't know what's going to happen in the future either. And Peter Lynch had a great quote back in the early 2000s, late 90s, where he said, if the Fed doesn't know what's going to happen in the next 6 months, how am I supposed to know? And that's why we build a portfolio for long-term growth. We build in, essentially a bond ladder in the portfolio for the fixed income portion because no one knows what's going to happen in the future with interest rates and all that. And I think that's the point that Warsh is trying to drive home with kind of his stance right now.
Mhm.
Yep.
Yeah, love it. All right. Well, we'll get to Bob's favorite part now, the economic scorecard. So, our GDP growth, this is the annualized number quarter over quarter. So, on the left side of the chart is the numbers from the last time that we spoke in January, or so the December numbers. And yeah, these are all kind of lagged naturally. But we were at a 4% growth rate. We're still in the positive territory in the 2% growth rate. A huge portion of this growth has been from the AI capex. It's like a aircraft carrier in the ocean. Like it's so hard to turn this ship around because we have so much stimulating the economy. It's kind of hard to mess it up. So GDP is growing. That's good. We'll take the win. Inflation was in the 2.7% range last time we spoke. The trueflation or the real-time data was even lower than that, a 1.2. The Bureau of Labor Statistics posted the latest print yesterday at 3.5, which was actually below the expectations of 3.8. So that's good. But then the real-time data from Trueflation, again, higher from where we were in December, largely due to the spike in oil prices and interest rates, but still not crazy, not bad, not outside of expectations. So we give that one the fair score. Unemployment was 4.4%, is now 4.2, so that's good, even better. Take it. Fed funds rate basically unchanged. Again, he held rates steady in that 3.5 to 3.75% range. So good there. Wage growth basically unchanged. Consumer confidence was bad, got even worse over the last 6 months. So again, that's not great. You saw that reflected in the consumer discretionary stocks, like consumers are feeling the pinch. But then the manufacturing PMI, which is basically anything over 50, means that the economy is growing from an industrial perspective and we're doing more manufacturing. So we went from below 50 to above 50, so that actually improved from fair to good. So we will celebrate the success there, and largely driven by all of the data center construction
Mhm.
projects. So,
And so, Nick, this goes to my point about where the current Fed fund rate is, which is in the middle there, of course,
mhm.
right?
Yeah.
That keeping it up and not, um, you know, uh, lowering it to appease any political, circumstances, right? Whether it's Trump or any other, person that may be in office in the coming, years and over the decades. the fact that they are staying independent and keeping it up until some of these economic indicators start to turn for the worse, so that again, we have that leverage to be able to help stimulate the economy if and when it becomes necessary. So,
Yep. Yep. Absolutely. So overall, hey, we have four goods this time. So we'll give ourselves a pat on the back. Good job, everyone, stimulating the economy. Yeah, so unemployment rate. I know Sean likes to take this one, so I'll let him have at it. But go ahead,
So
Sean.
yeah, I mean, I think the good news is right when we start to see unemployment rising, the Fed gets scared, and that's when they tend to lower interest rates. When we have a steady unemployment rate or a fully employed market, which we'd call it since it's below the historical average, then the economy is doing well. People have jobs, and people have jobs, they spend money. When they spend money, the market goes up. And so while we do see consumer confidence low with a fully employed market, the economy should continue to grow, right? So it's just another data point to say, hey, uh, if we think the market's overpriced, we're a little scared about the market. The companies are telling us they're hiring people and people have jobs.
mhm,
And so when you see the big spikes in after 2008 and 2020 during coronavirus, after the dot-com bubble burst, that's when you start to see markets pull back. But when we have a really healthy job market, it tends to be overall good for the economy. And a big key indicator of what the Fed looks at to determine if they're going to raise and lower interest rates.
Yeah. And also want to point out that we survived the government shutdown of 2025. There's a slight break in the data, but hey, it's all good. We made it
But
through,
we're
folks.
fully anticipating a 2026 shutdown if we're used to anything. I think that's
yep.
So maybe we'll have more gaps this year, something to look forward to. So, um, yeah. So on the topic of unemployment, AI taking everyone's jobs has been a big fear and a real fear for a lot of folks. And so, this was a great piece that the Financial Times put out to show that the companies that are the highest adopters of AI across all jobs and entry levels, specifically siloing that out, the ones that were the highest adopters tend to increase headcount the most. So that's encouraging, right? Versus
Mhm.
the companies that were low AI adopters did not increase headcount as much. So um, again, not saying this is like the definitive, that's it. There's no job loss from AI. But so far, it's been good overall. And
Mhm. Yeah,
go ahead, Bob.
and the thing I always come back to with charts like this is the whole correlation and causality, right? Does it just because it's correlated doesn't mean it causes something, right? And so, high adoption of AI probably comes from just companies that are good, strong, forward-thinking companies, and therefore they're growing and therefore they're hiring more people. So it doesn't mean that like implementation of AI is going to create more jobs. But what we're seeing is that even for the companies that are implementing and utilizing AI, it is not eliminating the need for them to hire folks, right? They might just be in different types of roles, right? So I think that just seeing this and that the whole idea that, hey, AI is going to take everybody's jobs and nobody's going to have a job anymore, it just isn't playing itself out yet in person in the data. Doesn't mean that that might change in the future, right? But just like the internet changed how we do jobs, just like the car changed how we use horses, right? Like all of these changes in the economy and in the market will have an impact on some jobs, but it's going to help grow the economy, is our firm belief, right? That it's going to help grow the economy, different jobs, all of that, and not necessarily a loss.
Yeah, yeah. We'll take it. Lower unemployment. Let's go.
Yep.
But that does not make consumers feel any better, Bob, clearly here. All right. So
Yeah.
I know this is another super busy chart, but this is looking at the consumer sentiment index or consumer confidence, another way to say it, over the last since the 70s. And then also the blue dots are what the S&P 500 has returned in the following 12 months. So just an interesting, analysis here. And what the data tells you is if you buy the S&P 500 when consumer confidence is low, that's historically been a pretty good winning strategy. On each of the last nine troughs, that's averaged a 24% return in the S&P 500. And today's number in May was even worse, but we are hovering near like rock bottom consumer sentiment, like 2008 level happiness and confidence in the market. So, yeah, the consumer is feeling it for sure. But that doesn't necessarily mean that, stock market's going to crash. In fact, by this chart, it would mean that, hey, stock market has plenty of room to run. So, uh,
Yeah, and again, with any of this data, with any of these charts, right, historical performance does not equal future results or whatever disclosure we have to put in there. But I think a lot of times what folks get caught up in is they say, hey, me personally, I'm scared of the market or I have this fear, right? And just because we have that fear and just because a lot of folks have that fear doesn't necessarily tie to what's actually going to happen in the coming months or years as it comes to the stock market or the economy, right? So one thing we always try to do as advisors is let's strip out the emotional side of it or do our best to manage the emotional side of it, have a proper plan in place, and not get fearful just because we're personally feeling that, but rather invest based on what we see happening in the markets, what our plan needs, right? What your short and long-term needs are, and ultimately, trusting that long-term vision versus, that fear that a lot of us may have just looking at, whether it's politics or the economy or whatever it is.
yeah, love it.
Mhm.
That's why we bring the planners into the investment calls, folks. Good job, Bob. So yeah, looking ahead into the back half of the year here, the outlook, the good stuff coming up. Kind of what we just talked about is the economic indicators are solid. The GDP is growing, unemployment's low, manufacturing's up. Those are all great things. Stock market earnings have continued to rise and fuel the market, not just speculation on the stock market. Like there's new earnings growth, which is great.
Mhm.
Um, the AI CapEx train isn't slowing down yet. And in fact, the better that the AI tools become, they become more and more viewed as a national security item. And so it doesn't seem like we're going to be slowing down at any rate, just to remain competitive and stay the best in national security. IPO enthusiasm continues. There's been a lot of enthusiasm about SpaceX. There's probably more to come in the back half of the year. But then the risks, right? So I'd say number one risk is that we have a prolonged war with Iran, right? That would be net bad for lots of reasons, probably humanity, but also just higher oil could be higher inflation, higher rates for longer. Nobody wants any of those things. Um, SaaSpocalypse 2.0. So again, those software stocks or the SaaS software as a service stocks, they need to, this is their big moment of reckoning, right? Like they're either gonna figure out how to use AI to their advantage or be disrupted. And so this next chapter, next 6 to 12 months, we'll see, if those incumbents are able to adapt and overcome. Um, and I know we just said the AI CapEx train isn't slowing, but if it does slow down, then that would probably not be good for the market as a whole, or the market would probably feel a pullback there. And again, we said, everyone is spending all this money on the data centers, the true ROI on the artificial intelligence or return on investment to be determined. So, we'll have to see how that lands, and we won't know until after the fact. And then political uncertainty. This is somehow midterms already. And so just the uncertainty of all the political drama and theater can definitely create anxiety in investors. So,
Yeah.
um,
And and that last one there, Nick, and we say this all the time, right? Like, and I think Sean, I know that we talked about it and you have charts that you love about it, but the political side of things, I know that it creates short-term volatility, right? Like if, a new president comes in, just in long-term views, right? When a new president comes in, when the Senate or the House changes over, or, certain political parties get more or less control, it scares things or it creates anxiety in the short run. But generally, what tends to beat all of that out is the economic stuff, right? Like we're going to have political volatility. I think that's always going to be something that comes up. But ultimately, is the economy in a good spot? I think yes. And again, going back to even the Fed chair, the fact that he's shown to be very independent, I think that that in and of itself will help to mitigate some of the political uncertainty as well.
Yeah, I think we always have to remember because the headlines are going to be coming out like crazy over the next couple of months. Is that companies are more efficient, they're smarter, and they move quicker than the government. So they're going to find a way to create value for their shareholders, regardless of who's in political office. If the House changes. We believe in the companies, and the data reflects that. I know we always think that one side does better than the other. The data doesn't show that at all. All right, all what's
Mhm.
happening in the world, how companies react, earnings per share, right? Are companies generating profits? That's what matters most. And by the time someone gets in office, it's going to change again. So
Mhm.
don't hold your breath for too long. We're long-term investors, and the elections are going to end up not meaning anything other than near-term volatility.
Yep.
Yeah. Wow. Look at that. Questions. We didn't get any questions in the middle of that. I told
We
you.
we did get one
Okay.
on the difference between 12-month and 20 or like
1 year
drawdown within
outlook.
the year on your IPO
Oh,
chart, Nick.
okay.
Um,
Yeah.
but Sean did a good job responding to that directly. And then I got a question here, Nick, that I guess any of us can answer. Concern about the level of the US deficit is rarely mentioned anymore on mainstream business media. Has it become a non-issue? What's our thought there? Great question, by the way.
So I will tell you, I'm reading the book, The Creature of Jekyll Island right now, which is a great read about how the Fed was created and the International Monetary Fund and all that. So if you haven't got it, and you want to be a nerd, Creature Jekyll Island. Certainly, there is some fear there with all of it, and I wish I knew the answer to that. It's hard to believe that all the debt that we have is not bad in some way, but I think one thing that our dollar is backed by is the U.S. military, and we're seeing that
Mhm.
put to work every day. So that's kind of the backing of our dollar rather than a gold standard or something like that. I think that time is going to have to tell. I don't think any economist has a definitive answer on that. We essentially have a currency that we can print our way out of anything. A lot of scary things in that Creature Jekyll Island book. But ultimately, I don't think anyone knows the near term or long term outlook because we haven't been in this play for long enough to know that answer. But you do think it should be. But Trump's philosophy anyway is that we grow ourselves out of it. Is that happening or is it not? So far, it hasn't. I don't know if anyone has the appetite to cut back spending to truly get in line, unless we, the people, say, "Hey, we need to stop doing this."
Yeah. Yeah. I I agree with Sean. Those are all solid points. And even outside of that, the other like I don't know, future saving grace that might save us all is robotics entering the workforce and seeing, new productivity from that, like true like humanoid robots everywhere. So, which is a very real thing in the next couple of years here. So, maybe that saves us from our impending terrible spending habits. We'll see. But yeah, overall, it's not like to your point, it's not like the front of the headline story right now. Like everyone's pretty content with where we're at, it seems. So, um,
Okay. And
right.
then another one here too. Do we look at economic scorecards of other regions to help in our international allocation to investments? So is that something that we're looking at, or is it more just based here in the US?
Yeah, yeah, good question. Yeah, we definitely look at all of those things globally, right? Even the most like US companies tend to do like half their business overseas on average. So like Microsoft, Tesla, Apple, they do like 40 to 60% of their sales in China specifically. So yeah, there's a lot that goes into that analysis and really like it's almost easier to start with, are there places I certainly don't want to invest in? And like we usually start there when it comes to the international conversation, like investing directly in Chinese equities. even if their scorecard looks, like a straight A's, it's like, I don't know. Like every time it gets too good, the CCP steps in and meddles with it, makes it not so attractive. So, yeah, we do look at all of those things, both from what's good, what's bad, what do we definitely want to avoid, what are some interesting opportunities as well. So,
Yeah. Yeah. And I think to your point, right, like because we are here in the US, right, and this is, our market, our economy, and the United States, quite simply, is the biggest driver of, kind of the economic flywheel across the world, right? Like making sure we're healthy ultimately leads to health across the world. But, so that's why we kind of tend to focus on what's happening here at home.
mhm. Yep,
Right.
absolutely. All right. Well,
All right. I think that answers all the questions. Sean, I don't know if you think we want to pop back to because we did have the question, Nick, it was on the IPO slide and their returns in the months afterwards. So if you
mhm,
just want to cycle back to that really quick, we could just make sure we drive home that point before we wrap it up here this afternoon.
sure thing. All right. So,
Okay. Yep.
yep.
So the question was explain the difference between 12-month column and 1 year drawdown.
Yeah, so 12 months is like if they IPO'd on March 1st, like what was the stock price on March 1st of the following year? And then the 1 year drawdown is like in between March 1st and March 1st, what was the max drawdown in that time period? And so 12 months versus 1 year max drawdown. A little bit, yeah, confusion there. Totally good
Sure.
question. Yeah.
Yep, but it's kind of like that intra-year chart that you
Yeah.
do for the S&P with the little red dots. That's
Yep.
just the how far did it pull itself down during the year, and that's the difference between those two numbers there. So,
Yep.
yeah, all right. Well, that's all we have. So if anybody wants a slide, we did have a question on the slides. If anybody wants these slides, we will, of course, be sending out the recording after the fact here. If you want the slides, just let us know. We can go ahead and send those over to you. There's, nothing proprietary here, so we'll just shoot them out to you. If there's anything else that comes up that you have questions on or that you want to dive deeper into, of course, reach out to me, Sean, Nick, any member of our team. We're happy to dive into that with you. But Sean, thank you so much for being on here this afternoon, man. Nick, thank you so much for leading it. Ryan, thank you for being there in the background, making sure all went well. And hopefully see you all next month for our next webinar. And appreciate you being here this afternoon.